What's up guys, it's Darren Jackson. Welcome back to the channel, and we're gonna go straight to the point because I haven't made a video like this in a while. We're gonna talk about 3 of my top safest monthly dividend growth stocks and ETFs that I feel like all new investors should get their hands on if they haven't already, as soon as they possibly can. Now, if you guys have been following my channel for some time, you're probably gonna hear some stocks and ETFs that I've mentioned before, but it's okay to get a refresher every now and then. It gives us more to talk about. And this is, again, for new investors. So hopefully this is something new for you guys, so you guys can do some additional research, ask some additional questions, and we can get started. So let's go. All right, so the first stock is a REIT. It's called STAG Industrial. For those of you guys that don't know what a REIT is, it stands for Real Estate Investment Trust. It's basically investing into the real estate stock market without investing into actual properties and actually having to deal with tenants face to face. So STAG Industrial deals with single tenants in industrial buildings, and they have over 450 properties in 38 states. I believe their biggest tenant is Amazon. They also have tenants with DHL Supply Chain, the US government, and Ford. So they're pretty much everywhere. As far as the growth factor, they do pay a monthly dividend, and that monthly dividend has increased since 2011, which was the year of their IPO. So they're consistently increasing even though they are a REIT. And I mentioned that because REITs have to pay 90% of their earnings every single month back to the shareholders. So the fact that they haven't had to decrease anything is pretty beneficial. Also, the safety factor within this REIT is pretty high in some interesting ways that I didn't think about before. So only having single tenants in these industrial properties can be a little risky, because if you lose that individual tenant, there is no second or third. That's just the property that's gone altogether. But at the same time, you lose a lot of the stress of having to deal with multiple tenants. On top of that, STAG has a pretty sound credit review, I guess, with that single tenant. Their ultimate goal is to be able to have tenants that have long-term contracts. Their average contract with all of their properties is about 8 years. So they're consistently looking at around 8 years of continuous income, which means that's more income for them and then more income for us as the shareholders looking for the monthly dividend. The next stock is another REIT. It's probably the most popular one, at least the most popular one that I've noticed or discovered in my almost 2 years of investing, and that's Realty Income. It's actually nicknamed the monthly dividend stock. Realty Income has tenants just like STAG Industrial, but their tenants are retail properties mostly. So they consist of Dollar Tree, Dollar General, Walgreens, Lifetime Fitness, Wal Mart, CVS, and Sam's Club. And they have over 6,500 commercial properties across the United States and maybe even some other countries. So the growth and safety factor of this company is probably the best out of all 3 stocks and ETFs I'm talking about today. They average a 15.3% annual return since 1994. They have 20 plus years of dividend payout increases every single year. And speaking of monthly dividend payouts, they have had consecutive payouts for 604 months. That's over 50 years of consecutive monthly dividend payouts to shareholders like you and myself. So the likelihood of the dividend payout with all these stats being either decreased or cut seems pretty minor. And I think the reason behind that, or I know the reason behind that, is the tenants themselves. As you can see from the list that I just gave out, with the exception of Lifetime Fitness, they really haven't been hit so super hard with the recent pandemic. Maybe at the beginning, but these are pretty high necessity tenants, especially CVS for pharmacy-like resources, Walmart, Sam's Club, Dollar Tree in general for food. These are companies that are going to continue to have foot traffic for the foreseeable future and then some. So that's why I feel like Realty Income is definitely a REIT, a monthly dividend stock that new investors need to get their hands on as soon as possible. Now, the third stock that I feel like new investors need to invest in for the safety and the growth is the Global X NASDAQ 100 cover called ETF. This ETF is actually really interesting. So it covers the NASDAQ 100. For those of you guys that don't know, the NASDAQ 100 is the top 100 largest by market cap stocks within the NASDAQ. So you're looking at stocks such as Apple, Amazon, and Nvidia. And what else is interesting is the way that QYLD, which is the ticker symbol, makes enough money to be able to pay us every single month. And the way they do that is by options trading. So investing into this is pretty much you doing covered calls, I believe, without actually having to have the money for it. So they basically purchase all these stocks within the NASDAQ 100 and they hold on to it for a month, and then they sell it at the end of the month and they collect a premium, which they then disperse upon to us, the shareholders, for the monthly dividend paid. Now, I've talked about this stock before and I didn't really think about how safe this was, but it actually is pretty safe for a couple of reasons. The first reason is primarily the fact that the top sectors within the NASDAQ 100 is technology. And technology at this point is either upgrading or it's pretty much staying the same. All in all, I doubt it's going away anytime soon. A lot of corporations, pretty much all corporations, are implementing technology or expanding it or upgrading it to benefit them. So technology will always be needed. The other reason is something that a lot of people may not think about, but it's the cash on hand. What I mean by that is a lot of companies have cash on hand just in case something bad happens, kind of like what's been going on this year and how it's been taking small businesses down and some large businesses, kind of making them a little bit fragile. But if you look at the cash on hand for some of the top companies within QYLD or the NASDAQ 100, it's in the billions of dollars. So that means if situations such as this were to result in less foot traffic and less orders, then instead of having to cut employees, they have a bank of extra cash that can keep them going for a period of time until this subsides, until the economy regains itself. So whenever you have companies with a high cash on hand, it increases the longevity of that company. And whenever those companies make up some of the largest sectors within this ETF, then that means this ETF will continue to grow, which also means it will continue to profit, which also means that us as shareholders will continue to receive a monthly dividend. That's why I feel like this ETF is a little safer than I thought. So I'm sure there are a lot of other monthly dividend paying stocks and ETFs that are pretty safe. So leave your comments down below and let me know what those are. Hopefully you guys enjoyed the video, and make sure you guys check out some of these other videos. I sincerely hope they help you guys out on your investing journey as they have in mine. I appreciate you guys watching, and until next time, take care.